In 2008, Iceland's entire financial system collapsed in less than a week. Banks stopped working. The national currency lost roughly half its value, and a country with fewer people than a medium-sized city suddenly faced debts larger than it could ever realistically repay. Not because of war, not because of natural disaster, and not because anyone planned to break the system. It happened because Iceland's banks had quietly grown larger than Iceland itself, and for years, that growth looked like success. To understand how this happened, it helps to start at the end. In late September 2008, executives at one of Iceland's largest banks, Glitnir, contacted the Icelandic government with a request. They needed help. Not long-term help, not a rescue plan, they needed cash, immediately. Glitnir owned valuable things, loans, investments, companies across Europe, but owning valuable things is not the same as having money available right now. If you own a house, you are wealthy on paper, but if the bills are due tomorrow, the house does not help. That difference is critical in banking. Banks survive on timing. They borrow money that must be paid back soon, and they lend money that comes back much later. As long as they can keep borrowing, nothing feels wrong. But if borrowing stops, even a healthy-looking bank can fail in days. This problem has a technical name, but the idea is simple. It is about whether money is available when it is urgently needed. Glitnir did not have enough. By the end of that day, the Icelandic government agreed to take control of most of the bank. The decision was meant to calm the situation. Instead, it revealed something much bigger. If one major bank needed help, the others might too, and Iceland did not have the resources to save them all. To see why, we need to go back. In the early 1990s, Iceland's economy was modest and cautious. Fishing was central, energy mattered, trade was steady. Banks were mostly owned by the government. Rules limited how much money could flow in and out of the country. This made the system stable. It also made it slow. Loans were expensive. Businesses struggled to grow quickly. Young professionals often looked abroad for opportunity. At the same time, the world was changing. Across Europe and North America, governments were opening financial markets. Money was becoming global. Capital could move across borders with ease. Countries that embraced this change saw rapid growth. Countries that did not risk falling behind. Naturally, Iceland paid attention. In the late 1990s, Iceland began reforming its banking system. State-owned banks were privatized. Restrictions on foreign borrowing were loosened. Banks were encouraged to compete and expand. By the early 2000s, 3 private banks dominated the system: Kaupthing, Landsbanki, and Glitnir. These banks were not designed to be cautious utilities. They were designed to grow. And growth in banking usually means borrowing money and lending it out. Here was the basic logic: borrow money where it is cheap. Use it where returns are higher. Keep the difference. At the time, money outside Iceland was very cheap. Interest rates were low. Investors were eager to lend. Global confidence was high, so Icelandic banks borrowed heavily from abroad. They borrowed in euros. They borrowed in dollars. They borrowed in British pounds. They used this money to buy companies, issue loans, and expand across Europe. And it worked. For several years, it worked extremely well. One of the key figures during this period was David Oddsson. As Prime Minister, and later as head of Iceland's central bank, he strongly supported liberalization. He believed Iceland needed to modernize, that it needed access to global capital, that it could not remain small and inward-looking forever. Many agreed. Economists supported the reforms. Politicians praised efficiency and modernization. International institutions approved. The system felt professional, modern, serious. By the mid-2000s, Iceland's banks were no longer local institutions. They were international. Kaupthing bought banks in Scandinavia and the UK. Glitnir focused on large corporate loans across Northern Europe. Landsbanki launched an online savings product abroad called Icesave. Icesave offered slightly higher interest rates than local banks in Britain and the Netherlands, not dramatically higher. Just enough. Millions of people moved their savings. From their perspective, this felt safe. Their money sat in a European bank. Deposits were officially guaranteed. From Iceland's perspective, the situation was more fragile. The deposits were foreign. The guarantee came from Iceland. At the time, this mismatch did not feel urgent. because nothing was going wrong. As the banks grew, Iceland changed around them. The national currency strengthened, imports became cheaper, people bought cars and traveled abroad, wages rose, tax revenue increased, unemployment stayed low, bank executives became well-known figures, the country felt confident, and confidence has a way of justifying itself. By 2007, Iceland's 3 major banks held assets worth roughly 10 times Iceland's entire economy. That means if Iceland produced 100 units of value in a year, its banks owned claims worth about 1,000. This fact was known. It appeared in reports, it was mentioned in meetings, but it felt abstract. The banks were diversified, their investments were spread across countries and industries, their balance sheets looked strong. As long as markets worked, the system worked, and markets had worked for a long time. Then, slowly, the environment changed. In the United States, problems began appearing in the housing market. Some loans were not being repaid, some financial products were poorly understood. At first, this seemed distant, but modern finance is interconnected. Banks lend to banks. Investors rely on confidence. When doubt appears, it spreads. By early 2008, borrowing became harder. This mattered because Iceland's banks depended heavily on short-term borrowing. Short-term borrowing means loans that must be repaid or renewed frequently, sometimes every few weeks, sometimes every few months. As long as lenders agree to renew those loans, everything feels normal. But if lenders refuse, the bank suddenly needs large amounts of cash, immediately. Behind closed doors, Icelandic officials began asking difficult questions. Could the central bank support the system if markets froze? The answer was uncomfortable. Iceland's central bank could create Icelandic currency, but the banks needed euros and dollars. You cannot print money you do not control. That meant the safety net was much smaller than the bank standing on it. Publicly, confidence remained the message, because confidence still seemed reasonable. On September 15, 2008, Lehman Brothers collapsed. This event shocked the global financial system. Banks stopped trusting each other. Lending froze almost overnight. Imagine a city where suddenly no one accepts checks or cards anymore. That is what happened to global finance. For Iceland's banks, this was devastating. They depended on constant borrowing to survive, and borrowing stopped. Executives called the central bank called the government. Meetings followed. On September 29th, Glitnir officially asked the government for help. The government agreed to take control of most of the bank. The goal was to calm investors. Instead, it triggered a realization. If Glitnir needed help, the others might too, and Iceland could not save them all. Over the next days, the situation unraveled. People withdrew money from IceSave accounts. British authorities froze Landsbank's assets in the UK. Kaupthing lost access to payment systems. On October 6th, Prime Minister Geir Haarde addressed the nation on television. His tone was calm. His message was not. He warned that the economy itself was in danger, not emotionally, mathematically. Emergency laws were passed overnight. The government took control of the banks. Domestic accounts were protected first. Foreign creditors absorbed losses. This was not dramatic. It was necessary. The immediate consequences were severe. The Icelandic currency collapsed. Prices rose quickly. Foreign debt became much harder to repay. People who had borrowed in foreign currencies saw their payments explode. Unemployment rose. Confidence disappeared, but the country did not stop functioning. ATMs worked, salaries were paid, stores stayed open. The system did not collapse completely. It shrank. Over time, Iceland rebuilt a smaller banking system, one that matched the size of the country behind it. Not because small is virtuous, but because systems must fit their foundations. The uncomfortable lesson is not that Iceland made foolish choices. The choices made sense at the time. Banks grew because growth was rewarded. Politicians supported success because it looked national. Citizens participated because life improved. Nothing clearly signaled danger. The system worked until it needed something it could not provide. The day Iceland's banks became bigger than the country was not a single moment. It was a gradual crossing, a series of reasonable decisions that led somewhere unreasonable. That is what makes the story unsettling. Not the collapse, but how calm everything felt before it happened.